All right, so very good afternoon to all of you. The topic that we shall be discussing today is cost of financing. And this topic bears some kind of orderly hierarchy with what we discussed last week, because um, I was giving you some kind of glimpse of the firm structure. And I mentioned that the first pillar of a firm is the financing. And the financing is where money comes from. Obviously, if the money comes from, it must be having a cost. And that cost aspect we shall be discussing in today's lecture. This is one of the strategic topics of corporate finance. And because I was in a fix that should I make it very condensed or should I make it more explorative, more extensive, or should I make it intensive? But I decided in favor of making it more extensive because the topic per se is very important. If I don't discuss those nuance of cost of financing, then I believe there's something I will not be happy with myself. So what I'm going to do is that this topic too, we shall discuss in two parts. It's quite a big topic, but I can assure you that it's very interesting as well. So we shall try. Well, I don't think there is a need to say try. We will definitely be in a position to cover it in 2 meetings, okay? Maybe meeting and a half, something, but we'll see. So cost of financing is your topic two. And when it comes to definition of cost of financing, what I can say is that cost of financing is referring to, or financing is referring to your capital structure. And broadly speaking, the capital structure is debt and equity. Of course, we have the hybrid form of financing that we studied last week also, that there can be warrants, there can be preferred share capital, and the different kind of new variants with frills and fancies. But traditionally speaking, we have, if we have very Puritan point of view, then the debt and equity are very traditional forms of companies financing and the funding of the capital. Debt carries cost of debt, equity carries cost of equity, and when we club them together, debt plus equity, it becomes cost of capital or cost of financing. Okay. A very challenging and very mind-boggling and rather very frustrating decision which corporate finance managers make during their board meeting is that if a project is worth spending of resources, given that the risk and return, dimensions. So it's very important that one of the very key decisions, or I would say that if I have to say that if there's a field called strategic corporate finance, then this cost of capital would definitely be a very important component of it. We shall discuss in the near future that how we decide, on what parameters we decide if an investment project potentially is doable or not. But that is the next phase of our study. But so the corporate finance managers, they spend a lot of time and energy and lots of arguments and counter arguments if a certain project is worth undertaking or not. The capital is underlining the financing side, and thus it relates to, in the income statement, it is signified by the interest expenses, whereas in the balance sheet, it is signified by the liabilities. And in the balance sheet, we have the current liabilities and the non-current liabilities. And this component of financing, some researchers, some scholars, they are of the view that when we want to see the cost of capital or financing, We should only look at the book value of equity and the non-current component of debt. But some people believe that no, we should also consider the current liabilities as well, the current component of debt as well. So basically, the capital or financing is an aggregation of the debt and equity. And the cost of capital or the cost of financing is also called weighted average cost of capital, because we're combining the relative share of debt and equity, and then we multiply them with their respective costs, and thus we arrive at the weighted average cost of capital. The cost, when you are calculating the cost of capital, we also need to go beyond the firm, and we need to see that what is the hurdle rate. The hurdle rate is the rate which is like a benchmark, is like a kind of, as you can see the name hurdle. When I see this word hurdle, I visualize the 110-meter hurdle race, which basically means that you are fine as long as you jump over the hurdle. Okay, if you touch the hurdle, or if your jump is below the hurdle, then definitely you will hurt your ankle and you will not be able to continue your race. Okay, it means that for a company, it's very important to it must produce the return that which is over and above the hurdle rate. And the hurdle rate can be many. I mean, the most commonly used hurdle rate is the treasury bill rate or the bond rate that we see. So that is something which impose a minimum requirement, and this has nothing to do with the company, because this is something we see from the market. This is what we see from beyond the firm. And as long as a firm's expected return on a project is over and above this hurdle rate, which I mentioned, some people say that they take the short-term treasury bill. Well, the bill is always a short-term, but some people say that it should be 10-year bond rate, which can serve as a hurdle rate. So as long as the project which you are planning to undertake can jump over this hurdle rate, then that project may be acceptable. I'm not saying that that project would be acceptable, but it qualifies to be accepted. I'm just building up some, the discussion around the cost of capital. Similarly, we also use these couple of phrases, that the required return and the cost of capital or cost of financing. They can be similar, but they are not same. Okay, as I wrote in this last sentence. When I say required return, it shows that that investors expect, and you must fulfill investors' utility function in terms of their expected return. So if a project can generate 10%, and this is exactly what the investors' expectations represent, then this is called required return on investment. We have different models to apply it, and we shall discuss them as we carry on. Something similar is called cost of capital, and we shall calculate it quite in depth. It shows that the firm must earn 10% on the investment so that it can compensate its investors for the use of capital to finance the project. So if you look from the revenue side, if you see from the firm's return side, then the same phenomenon can be called as a required return. But if you see from the cost side, it can be called as a cost of capital. Okay. In theory, they are different, but in practice, they can be same. And we can also make a derivation from these two concepts and call it discount rate. I mean, whenever it's too early to tell, but when we shall study the study the corporate investing, you will see that we use a certain discount rate to estimate the future cash flows generating from the project. Okay, so these three terms, even though in theory they are not same, but sometimes in practice we use them as synonyms. Why we use them? Because sometimes there's a lack of data, and maybe sometimes we don't have that much conceptual sophistication to calculate them separately. So in reality, for the practical purposes, these three terms can be used as interchangeable, even though, as I said before, they're not same. They're not same. Yeah, they can be similar, but not same. When it comes to cost of equity, there are two approaches that we apply. The first approach, which is very old and very widely accepted, is the Gordon's dividend discount model or the dividend growth model. And the second, these are the two approaches. They approaches that we can be different techniques, but when it comes to approach, we have broad approach. The Gordon's dividend growth model approach, this approach was given by M.J. Gordon, University of Toronto, and this paper, his research was published in 1956, and it was not alone. I think there were three authors, if I'm not wrong. Let me check it. Then this approach was given, and the core idea of this approach is that the firm's dividend will grow at a constant rate, G. So we use this symbol G for the growth rate, and this growth rate is assumed to be constant. The idea of Gordon's of constant growth rate is that maybe in the short term, there can be fluctuation, but when the firm becomes mature, or when you are calculating the growth rate of dividend retrospectively, then when you find the average, it will be pretty much constant. Okay, so the deviation would be very less or almost negligible. So the firm's dividend will grow at a constant rate. So implicitly here, we can say that Gordon assumes that the firms give dividend. So even though we know that the firms not always give dividend. Maybe look at the time period. It was 1956 published article. And at that time, it was not a norm for the firms not to give dividend. So the firms were, so it could have been laughable if you ask at that time that, hey, does this firm give a dividend? Well, almost every firm gives dividend at that time. And then the price per share of the stock, okay, we symbolize it with P0. The current stock price, 0 always means the current, the time, the 0 time. And then we have the D0, which is the dividend, which we have just paid. I deliberately use the word just paid, means in 0 period. And D1 is the next period expected dividend, which will grow at the constant growth rate G. Or subscript E is the required return on the equity stock. And when we put all these numbers together, then the current price P0 becomes equal to, if we solve this equation, so there is D0, the current dividend multiplier, so we compound it at G growth rate, and then we divide the entire term with the required return on equity minus growth rate. And then this, because it's forecasted, so it becomes D1. So D1 becomes the expected dividend in the next period. So the overall, your formula becomes the current stock price is equal to expected dividend, and this divide by expected return on equity minus the growth rate. Okay. The question here is that Somebody can question that why do we need a formula to calculate the current stock price? Well, one can expect that what would be the next stock price? What is the expected stock price? That is fair. That makes some sense. But if, for example, somebody asked me, can you calculate the current stock price of Finnair? Hey, why do I go through this process? Why can't I just see in the Bloomberg or Reuters page or Yahoo Finance that what is the current stock price of Finnair? But remember, the Finnair price, the stock price, which I can see in the web pages, is the actual current stock price. This is also the current stock price, but this is the notional theoretical stock price. So I can say that if I use this formula, and according to this formula, Finnair stock price is 15 euros. But when I see the web page and I find that the Finnair stock price is 20 euros. So actual 20 euros, notional, theoretical, natural, normal, 15 euro. So the real actual price is 5 euros more than the price should be. So 20 euro is the price is, 15 euros, according to this formula, the price should be. So we can see that, or we can say that Finnair stock is overvalued. It means that this formulation gives us benchmark. Otherwise, we will never be able to say, is this 20 euros price now, is it high or low? So we need some benchmark to compare with the theory, that is reality different from the theory or not. And this formulation gives us a theoretical viewpoint. Okay. Yeah. So this is how we can calculate the Gordon's dividend growth model. Some assumptions. The first assumption is that the firm do not change its operations significantly frequently. So we assume that the firm is in very much like a status quo, which means that it doesn't change its operations. It doesn't bring significant changes to its operations. The growth rate of the company is very constant, and maybe that is why the company is growing at a constant rate. Therefore, the company's growth rate of dividend is very much constant. So maybe it comes from that idea. The company has stable financial leverage. The leverage here means that the ratio of debt to equity. So company doesn't change its D to E ratio. The debt to equity ratio doesn't change. It's a stable. And then the company's free cash flow is paid as dividend. So whatever you get from the free cash flow, you give it as in the form of dividend. So these are some of the assumptions about the model. Okay. Maybe we have an example. Greater States Public Service, a large public utility, is paying a dividend of $4 per share. So it has paid in the last year. Okay. The stock currently sells at 60 per share. The dividend is expected to grow at 6% per year into the indefinite future. What is the cost of equity capital for Greater States? Yeah, so you can calculate that the dividend was €4. Was it $4? Yeah, last year. So in the zero period, and then it has grown at 6%. So now it's 4.24. That calculate D1, and what we need else? We need R, and we have the price. Okay, we have the stock price, and then we need the expected return on equity. So we don't calculate according to this notion, but we slightly modify our formulation. So here in this question, what we need to calculate is the expected return on equity. Yeah, what shareholders do expect. So when we put these numbers together, and we find out that 13.07 is the cost of equity, is what investors are expecting, the shareholders are expecting. And this, so you can see here that in this example, now see what this is something tricky, because I just said that this is a notional price because I was meant to calculate the notional price. But what happened here is that in this, even though the formulation is same, but in this question, I have been told to calculate the cost of equity, the expected return on equity. So the same price, which otherwise I would have calculated if there was a data of D1, RE, and G, then I would have calculated the notional stock price. But the fact is that in this question, I am given the actual price and I'm asked to calculate the expected cost of equity. So something would be always expected in this entire equation. Okay, so here I don't bother to calculate the notional price of the stock because I can't, given the numbers. Okay. But what I can calculate expected is the expected cost of equity, which investors expect. Okay. There are two ways to estimate this G. Well, we can calculate the historical growth rate, or we can use the analyst's forecast. If you believe in the history and you think that the history teaches us lesson and the history repeats itself, if you are more like a fundamental, if you are a fundamental investor, which we shall discuss, then you might use the historic growth rate as a benchmark to forecast the growth rate of dividend for the future. Or if you don't believe in the history and if you are very technical, you're very how to say, you're not a chartist, you rather use the technical information. You believe that the history is buried, it's past. So it's like if you believe in the random walk type of model, then you are fine with having a look at what analysts are forecasting about the future growth rate of dividends. I don't want to deviate now, but at some stage, I will take you to the Yahoo Finance pages or Reuters pages or Wall Street Journal's pages, and we shall discuss more in depth that what type of recommendations which analysts publish on these web pages can be very useful for you. Okay, so we can also use the analyst's forecast about the future growth rate. Okay. It's available from different sources. All right, so here, or we can also use the dividend which has been paid for the previous years, so 5 years. So we can calculate some kind of average, which is basically the historic growth rate. So in this case, for example, if I don't use the analyst forecast, and I want to take some kind of historic analysis, then I find that this hypothetical company, for the last 7-8 years, the dividend has been paid, different numbers have been paid. And then from here, if you do the Excel, then I can calculate the growth rate of dividend. For 2012, it come to be 1.55 because it's a difference of the two. So the way you can calculate is in Excel, if you put the sign of equality and put the brackets, the current dividend 1.31 minus the previous dividend 1.29, the bracket closes, divide by the previous dividend, and that would come out to be 1.55. And if you drag it down, you can calculate the dividend growth rate for all the years given in this study period. And then from there, you can calculate the average dividend growth rate. It could be arithmetic average, or it could be the median dividend growth. Okay, if the data is for many, many years, and the data is quite abrupt. I mean, the dividend growth rate, let's say I'm considering last 30, 40 years, and the dividend growth rate is fluctuating a lot, then I would prefer median growth rate rather than the arithmetical average dividend growth rate. So that's more like a mathematical property. Some advantages of this model. Simplicity. The model is very simple. You don't have to learn very scary econometric equations. It's quite easy, actually. As long as you know the dividend paid, if you have some estimates of the growth rate of dividend, if you can find out the return on equity, and then you can find the notional price. Or if you don't want to go in the notional price, you can use the actual price, like in this case, and can calculate the forecasted or the expected cost of equity. So basically, all you need is a dividend, some information about the dividend and its growth rate, some information about the stock price, and that's it. So that is something really good, that this model is simple and easy to use and hopefully understand as well. Well, you can tell me if it is easy to understand or not. But there are many disadvantages of this model. The first very obvious disadvantage is that this model is only applicable to the companies which pay dividends. So imagine you are a firm like some tech company or a media company, and you don't pay any dividend, then I won't say it's impossible to use the model, but actually it's quite complicated to use it. Traditionally, companies have been paying dividends, almost all the companies. It was only, I think it was in when was President Nixon? Yeah, there was some act in the US, and that would put restriction on the dividends, that you can't pay dividend unlimitedly. There has to be some cap on dividend. And as a result, the investors were very angry, and they wanted to move to Europe or elsewhere from American companies. And at that time, this idea of share buyback or the repurchase came into notion, so that the people who were very angry with the limits on dividend could be compensated by something else. But eventually, this share buyback or the repurchase is now even more popular than the dividends in many cases. So to cut the long story short, if you are a company which doesn't pay the dividend, then it can be a big challenge for the applicability of this model. The second assumption is that the dividend grows at a constant rate is also subject to criticism, because nothing is constant in life. The business dynamics change, the capital structure change, and all these things keep changing. All the important decisions of the firm, they keep changing. And as a result, the ambience, the surrounding of the firm in which it works, they keep changing. So when your free cash flow changes, when your revenue changes, when your assets, liabilities change, then it's a little bit hard to understand that why should we assume that the dividend also grows at a constant rate, even though the good news is that the researchers these days, when they apply this model, they have developed variants of the model in which they may give up the assumption of constant dividend growth rate. And the third assumption is that there is no allowance for the degree of so it doesn't really consider that the life can be uncertain. And that is why, because it assumes life very linear progression. And that is why they assume that the dividend grows at a constant pace. Yeah. And one more assumption, one more disadvantage, which perhaps I forgot to add here, is that have a look at the formula. The formula says the current notional theoretical equilibrium natural normal price, or even the latent price, is equal to D1 divided by RE minus G. Now, here, I want to draw your attention. It means that this denominator has to be positive. Just imagine that D1 is 10. The expected return on the shareholders' investment is 8%. And the dividend growth rate is 10%. So this will be 10 divided by minus 2%. And if you divide 10 by minus 2%, it would be how much? 10. It will be about 500, I think, but with a negative sign. It means that the expected or the theoretical price of the firm is minus 500, which is completely nonsense. How can the theoretical price be negative? This is something very weird. So that is, again, we have to keep in mind that in a situation where RE minus G comes to be negative, then this whole formulation flops. Then what do we do? Well, then we have to change some assumptions about expected RE, or we have to do something. We have to change something, because with the given formulation, if this denominator comes to be negative overall, it doesn't work. Fortunately, we have a solution for the first disadvantage, that if the companies don't pay dividend, then the model doesn't apply. But in the next example, or in the next subsection, we shall find out some way out that even if the companies do not pay dividend, we can still apply this model. For example,
onko hyvä oppitunti mulla menossa?
Okay. Many companies do not pay dividend, especially during their growth phase. Now, this growth phase could be very early in the company's lifetime, or it can come later on. But many companies, when they are growing very fast, they don't pay dividend, and they would prefer to recycle the dividend in the company's investment. And not that they are very steadfast about it, but even the investors, the companies reinvest the dividends or the profits back to the company, flowing back at the behest of the investors. Okay, so it means that if that is the case, then the model could be difficult to apply, but we can do something, actually. If I say a lot of things about it, it can be complicated, but let's see what we can do. Here I have an example for you. Assume that there's a company called Zeta Incorporation. It has neither paid any dividend in the past, nor it has any plan to pay in the near future. So that this company is totally ignores dividend. Imagine it starts paying dividend $1 5 years from now. So if it is 2021, maybe it has some idea that, okay, all right, this is the 5 year of growth period. We don't pay dividend, but I think we will mature in 5 years' time. So the velocity of our growth will go down. So let's pay the dividend then. And they decide that, okay, we'll pay $1 dividend in 2026, 5 years from now. And then they have some forecast that, hey, this is the 5 year growth period. We may grow at 12%, 9%, 13%, but we know that after this when this highly growth period gets over, and then we become more stable. Let's assume that our company will pay $1 dividend, and this will grow. Then after, it will grow at 5% from then. Well, in that case, we can use the discounted cash flow, the way we discount the cash flow, and imagine that the discount rate that we use, and this discount rate includes basically the return on capital as well, which we will be. That is why I was using that. Sometimes we can use the expected return on equity or the cost of capital as a discount rate for the company is 11%. Let's assume that. Don't ask me where it comes. I just imagine these numbers. So it means that when you pay dividend in the 5th year, you can calculate the notional price of the stock in the 4th year. So if $1 is the dividend you pay in the 5th year, then what would be the notional expected or theoretical price of Zeta's stock in the 4th year? All right, $1 divided by 11%, which is the cost of equity, and 5% is the growth rate. It comes out to be 16.67%. It means that the theoretical price of Zeta Incorporation in the 4th year should be 16.67. But that is the 4th year. What about now? Well, then we are discounting backward. And now we have the price, we have the stock price of Zeta in the 4th year. And then we discount it backward 4 years for the 4th year to 2021, and it comes out to be 10.98. In other words, if you are looking at what is the theoretical price of Zeta Incorporation now, it is 10.9%. It's like a fair value stock, 10.98. We got one more phrase, fair value. And if the current market price of the stock is more than 10.98, it means that the stock is overvalued, and before it falls, you sell it. And if the current market price is less than 10.98, it means that the market is not treating the stock price of Zeta very nicely, but it's just a matter of time that the stock price will go up. So it means that Zeta is selling undervalued, so you better buy it. And here I put my sign of exclamation or the questioning, because I believe that in finance, nothing is absolute. So this sounds like, when you read this paragraph, it looks very prescriptive, as if I'm giving you a prescription that, hey, you know what, 10.98 is a benchmark. If it is more than 10.98, sell it. And if it is below 10.98, buy it. But that's not a mantra for every investor and for every situation. For this, we need to look at the risk profile of the investors that we shall discuss in the next subsection. The next approach that we apply to calculate the cost of financing is the security market line approach, SML approach. But this approach is very exhaustive, unlike the dividend growth model, which has very simple formulation. This SML approach is very exhaustive in terms of its conceptual nuances. So therefore, we need to go a little bit off the track and discuss something else before we come back to this approach. Here, we need to know about the nature and the characteristics of some investors. We have different types of categories, but of course, I will discuss only a few of them. One very important categorization of the investors is called value-based investors. Okay, the idea of the value-based investor is that they want to find a wonderful business at a fair price. There's always some stocks. When you act like an analyst and when you are digging deep the data and the market dynamics, you will always find that, hey, you know what, these are some companies which are underpriced. The price that they carry in the stock market is below what they deserve to have. Reasons? Well, the one big reason is corporate governance. Maybe the board of directors and the leadership of the company is not very conducive for the company. So people who run the show are making bad decisions. Otherwise, companies producing the goods, whose demand is going to stay for a long time. The company has fantastic infrastructure in terms of technical financing and all those things. Everything is fine except people who are at the helm of affairs. Another reason is that there has been some scandal in the corporate sector about this industry, where this X company is in. And as a result, the entire industry is having crisis of loss of reputation. And as a result, all the companies in this industry are experiencing a downward price trend. We have seen in the past that some oil companies did very bad things. And as a result, the oil industry, the oil sector, had a very bad reputation. And even those companies who were not involved in these kind of unhealthy practices, even they experienced very bad stock price, very unfavorable stock price. And afterwards, a few years later, we found that some automobile companies, they cheated very substantially. And as a result, all other automobile industries, they also have to bear the bad reputation. And third reason why this lean patch comes is that the company is undergoing very big, very massive scale restructuring. It could be business restructuring, it could be financial restructuring, it could be anything. But there is some big thing is going on in the company. And because of these factors, some are bad reasons, some are good reasons. For the time being, the stock price of the company is below what it should be. The notional price, okay? So we always have a notional price in mind. And as I mentioned here, that it's more like a diamond in a rough. The stock is not a junk, actually. It's not something which you will repent, but it's something is really good. All is fine, except that the market is treating this particular stock unfavorably. So the value-based investors are always looking for such stock. They are doing this kind of treasure hunting, whereby they find that, find up the cheaper price, cheaper stock, hold it till the market anomalies gets over, and then the price then the stock will find its natural equilibrium, what it is capable of or what it is deserving. And that time you can sell the stock and make the capital gains. So they are looking for good stock, fair business at a fair price. Rather, I should say that they're hunting for the fair business at the unfair price. And once they buy it, they're looking for the unfair price to become fair price. And when it becomes fair price, then they are selling and they are offloading the stakes in the company, and they hopefully they they make some money. That is a basic idea. That is a basic philosophy of the value-based investors. Generally, I always recommend some theoretical, some the academic journal articles to you. But I was very much impressed by this. Is something practitioners' website. Okay, not very theoretical, but people seeking alpha is a very good article I found on this website, and I found it and I shared with you. Stocks top factor based value investing. So it's really good article and it's not complicated. I recommend you that you, whenever you have a time, have a look at this. Yeah, I think this is something which I discussed already, that there is always a certain fundamental intrinsic equilibrium, normal, natural, notional price. And if the market price of this stock is below the fundamental price because of the reason which I already shared with you, in that case, you can consider to be a good bargain if you are a value-based investor. Okay. Statistics are very important in corporate finance or in any form of any discipline of finance. If you ask me that which are the indicators who I should look at to make a decision if it is undervalued or overvalued, then I would say that the price to earning ratio is a very good indicator. Okay, if the price to earning ratio of a stock is below the price to earning ratio of the industry or the sector, it means that the stock in question is undervalued. Okay, where can I find the example? What do I have in the next slide? Wait a sec. If you, yeah. So here we have BP PLC, and I've got this data from New York Stock Exchange on the Reuters.com. And here we see that the BP PLC, the price to earning ratio is 5.63, which basically means that an investor, on an average, the investors, in order to gain, to get $1 from the company, the earning per share, is prepared to invest $5.63. But imagine you are taking the industry index. And when you take the industry index, it comes to be 10.63. It means that for the overall industry average, an investor to get $1 is prepared to invest 10.63. Whereas for BP, this number is 5.63. It means that the investor is not keen to invest beyond 5.63. Maybe he doesn't see any promising future of the company. And if all else is equal, and when you compare the price to earning ratio of a company vis-a-vis the industry index or the sector index, or even sometimes you are using the index, for example, FTSE 100, or like if it's a British benchmark, or if you are using the some NASDAQ index, in that case, you can find out that if a particular company, its stock is undervalued or overvalued. And I would say that it's a very technical job to calculate, to do the modeling if the stock price is undervalued or overvalued. But as a starting point, you can see the price to earning ratio as a good comparison in order to ascertain if the stock price is undervalued or overvalued. Okay. Okay, so We are back. The slides. Okay. And then we have the next. We have the growth-based investors. That's the next category. I think that will be very important for you to understand. The growth-based investors, they focus on the firm that will, according to their expectations, they would experience a faster growth than the other companies in terms of revenue, the stock price, earnings, cash flow. The companies which have a very bright future. The growth-oriented companies are more likely to reinvest, as I discussed in one of the examples before, that sometime when the company has several highly positive net present value project, and they are coming up one after one, another and another, and the series never stops. Then the investors are very happy not to receive the dividend and let their so-called dividend to be recycled or reused by the company back into the projects. Okay. So that is the situation for the growth-based firms. Now, the growth-based investors, they believe that that they are, if the price to earning ratio, if they find that the stock is overvalued, they don't sell it. They just do opposite to what the value-based investors do. The growth-based investors may buy it because they assume that why the stock is overvalued in the first place. Well, the stock is overvalued in the first place because this company and the stock is highly favored. People are desperate to buy it. That is why the price to earning ratio is already higher than its theoretical value. And this will go higher in the future. So the idea is that they buy expensive, the growth-based investor buy expensive because they hope that it will become even more expensive in the future. Whereas the value-based investors, they buy something cheaper but cheaper doesn't mean that it's not a good investment, but just because there is some unfavorable treatment given by the market to this stock. So their idea is that they buy cheaper, the value-based, hoping it will go up. The growth-based investors buy expensive in the hope that it will be even more expensive in the future. So the mindset, the notions, so they between of the value-based investors and the growth-based investors are very different. And once again, they can apply the price to earning ratio. So if the P to E ratio of a stock is higher than the industry or some suitable other benchmark, then it could be a good indication for the growth-based investors to buy it because it can rise even further in the future. Something about the growth-based investors and something about the comparison between the growth and the value-based investors. I was looking for some academic articles, which I found also, and I would share them with you. But I thought that maybe sometime it's nice to see the practitioner's perspective also. So I'm sharing them with you. Have a look at them and please let me know next week when you read them that is anything interesting you want to share with me about these articles. Okay, but let's take a short break now for 10 minutes and then we will carry on with the slides. When we have this discussion about the risk orientation of the investors, then it becomes important to address these two questions also. because remember that a very important parameter of categorizing the nature, the type of investors is the risk element, that how well prepared they are, in a position to face the risk. Okay, then these two questions are, what are the nature and types of risk which these investors encounter? In other words, the question refers to ascertaining the systematic risk and the unsystematic risk. And the second question is, how do investors translate this risk measures into the risk premium? Because after all, when you are calculating the expected return on equity, you are including this element of riskiness. How does this riskiness, which is a qualitative phenomena, how does it become a quantitative one, and how does it gets added via risk premium when you are calculating the expected return on equity? Well, there are different models to calculate the expected return on equity, and one of them actually we have discussed already, the Gordon model. It's a fantastic model, but the one which we shall discuss in the time to come is another one which is widely used, CAPM, Capital Asset Pricing Model. You might have done it before in some other course, but now we shall discuss it more from the corporate finance point of view. So these are the two important questions which it's important to address. The systematic risk is inherent. They are absolute. They are available, or I would say that the systematic risk is the risk which every firm, industry, sector is susceptible to, which is faced by. So this is something, the market risk. This come from the market variables. This come from the macroeconomic variables. So these are the risks which are available to the entire market, entire sector. Okay, and because this risk is affecting all the firms, and then diversification, which is considered to be a phenomenon, considered to be a combat mechanism to reduce your risk exposure, but it will not work in case of systematic risk, because even if you are investing in the one stock in a country, the companies in a country, or you invest in almost entire sector or the entire market, the systematic risk would affect you. So the diversification will not be able to solve a problem. That is why systematic risk is also called undiversifiable risk. When the inflation goes up, when the exchange rate of the local currency vis-a-vis the other hard currencies goes down substantially, when the interest rate rise, when the political climate becomes very, very unhealthy, then it doesn't matter. You invest in one stock or you invest in 1,000 stocks, because then the diversification will not be able to reduce your risk exposure. So this risk is come from this risk. Remember, firm is an entity, and this risk is not grown by the firm. It comes from outside. It comes from basically the macroeconomic factor. So the systematic risk is a broad factor of type of risk. It's also called market risk. It's called business risk, macroeconomic risk as well. Interest rate movements, recession, inflation, war, even climate changes. If there's any nature's fury like tsunami or Katrina, and what we saw some years ago in Japan, those are the systematic risk. Okay. Systematic risk, the only thing which comes to my mind which can help to insure against systematic risk is the company's rational system risk management strategy, and that involves hedging a lot. Okay, so the use of financial derivatives can be a technique to hedge, to protect yourself against systematic risk. The unsystematic risk is like I often use this phrase like a homegrown risk. It is the risk which you are facing, but your neighboring company is not facing it. Okay, that is why this is called company risk or industry-specific risk, or it's also called diversifiable risk, because it is only, this risk only come from one company. So if you increase your portfolio, then the relative share of the risk coming from a particular company will go down. Or it's a micro risk, or it's also called firm specific risk. Sometimes we also call it residual risk, leftover risk, because the firm faces total amount of risk, and when you subtract the total systematic risk, then what is left is called residual risk. But this is the risk which basically come from the company per se. Okay, it doesn't come from outside. Okay, for instance, the rate of inflation is constant, the exchange rate is not fluctuating, the interest rates are stable, but there is a strike in a company, particular company, or there is some major technological breakdown of a company. Okay, the technology is so obsolete. So that risk is affecting the return and the performance of that company only, not the next door neighbors at all. Okay, but sometimes it happens that sometimes it can happen that a risk which is unsystematic in the beginning can become systematic risk at a later stage. How to say it? If there is a crisis in a bank, a particular bank, then it can spread out to the entire banking sector. And if it happens to the entire banking sector, it can engulf the entire economy. Okay, so even though the risk is very minuscule, it's only relevant in the context of one organization, but it can spread at the speed of light. Similarly, one more problem which comes to my mind is the labor unrest. Sometimes it happens. If you notice the very big trade union strikes, the labor strikes, you will find that they're always starting in one company or in one industry, and then slowly it become the countrywide strike. So yeah, so there is a relationship between systematic risk and unsystematic risk, but there is a solution to unsystematic risk, and that is the appropriate diversification. I want to take a halt here, and I want to ask you one question, because you guys have been very quiet. I want to wake you up. I want somebody to tell me, why did I use this phrase, appropriate diversification? I mean, I could have written the amount of unsystematic risk can be reduced through diversification. But what I said is the appropriate diversification, and I highlighted this word appropriate. So it's not a random expression. So what I want you to search, do some mind boggling, do some mind mapping, and please tell me that what is the relevance of this word appropriate diversification. All right. We carry on our mission. When risk and return are like two sides of the same coin. It's like day and night. So anything which one accompanies the other. If you only talk about the risk and you do not include return in the discussion, then we are missing something very important. And if you're only talking about the return and you are not caring about the risk, then the discussion leads to nowhere. So whenever you are talking about the return, you need to bring in the discussion the risk factor as well. And because I was discussing with you the risk factor, so it's very important that we talk about the return also. Otherwise, the discussion would be incomplete. When we calculate our expected returns, total returns, the total returns are the actual return which we get. For example, if I find out that, hey, if you invest 1 million euros in a portfolio of 6 companies in Finland, hypothetically in 2010, what has been your total returns? And you find out that the total return has been 10% a year. The annualized total return has been 10% a year. And then I asked that, hey, could you also calculate what was expected during this time? And you find out that by using dividend discount model or by using capital asset pricing model, you find out that the theoretical return was 6%. So it means that there is an element of unexpected return here, and that would be 10% equal to 6% plus the missing figure would be 4%. Okay, so whenever you talk about the return, there is always an element of unexpected return, and this is also called the abnormal return. So the return which you actually achieve minus the return which was expected out of this portfolio or a stock. Let S denote the total number of economic situations in a country, region, world. It's more like a disclaimer. And the RI is the return in a given situation. S from the stock of ith firm, and P is the probability of a situation. Then the expected return would be equal to sigma summation of situation 1 to the total number of situation times the probability of situation and the return of the ith company's stock in that S situation. The probability is the likelihood. The probability is the expectation. Probability is behavioral. Probability is introspective. Probability is a reflection of your certain mindset. You can be very euphoric in certain situation and you put very high probability in favor of occurrence of an event. In certain case, you may be a bit depressed. You can be a little bit, you're not very enthusiastic, and you could put a low probability. So even one person can differ in assigning probabilities to a different situation or a different event in the different conditions. So probability is highly subjective. Probabilities are historic also. For example, if you study some statistics book, and you will find out that if we have a dice which has 6 faces, and if we throw the dice on large number of times, then the historic evidence shows that the probability of each face showing up is same. But if you throw the dice 1 or 2 or 3 times, it could be 6, 6, 6. It happens with me many times that when we play Ludo or something, you throw 6, 6, 6, but that's not that the probability of having the face 6 is absolutely 1, no. But if the dice is fair, and I have been throwing the dice for thousands of times or tens of thousands of times, then the probability of each face showing up would be 1/6. So almost same for all the faces. The same apply. So the probability is not only subjective, but it can also be historic. Financial media, we see that when you see some analyst forecast, we see a lot of probability involved here. Sometime it happened that you read the recommendation of 10 analysts, and it's a very divided house. 6 are saying buy, 2 are saying hold, 2 are saying sell. Why are they not unanimous? They have equally qualified staff. They're equally reputed. They're equally big. They're equally experienced. It is because the probability they assign on the occurrence or non-occurrence of certain events or certain things is different. So there is a certain mindset with which those companies, well, these analysts are also companies, by the way. So they have different perceptions about the future events. Okay, so therefore, there's a lot of subjectivity, a lot of behavior involved in finance, and one of the very popular discipline of finance these days is the behavioral finance. Have a look at this question. Some analyst is saying that the economy will grow at 1% GNP. And there is a 25% probability that the growth, the gross national product of the country would go up by 1%. There'll be 1% increase, and there are 25% chances. So I think he's looking very downward side that, hey, worst come worst, economy will grow at 1%. And then if very overestimated, very positive, overly positive estimate is 3% of GNP growth. And these two extreme, very low and very high, 1% and 3% is 25, 25. Most likely, next year, economy will grow at 2%. And there's a 50% chance of it. So it looks like a very normally distributed probability curve. 25% very low, 25% very high, in the middle, 2%, 50%. Yeah. And if the economy is growing at 1%, then the stock of a particular company or portfolio of particular stocks will rise at -5%. So there'll be, if the economy is growing at 1%, then the stock of the company would be basically going down at 5%. If the economy is growing at 2%, then the stock will be increasing at 15%. And if the market is really, fabulous 3%, then look at the stock, then the stock price will go up by, or the stock return will go up by 35%. Okay, and now based on this, we can calculate that if now here we apply the conditional probability that if economy grows at 1% GNP, then the multiplication of probability and the return in a state means not the country, but the state means situation, would be multiply column 2 and 3. We get this one. And if the condition is that economy is growing at 2%, then the probability multiplied by the return of the stock is this one. And if the economy is growing at 3%, then the stock will be growing at 35%, but the probability that it will grow at 35% is 25%, and then you multiply them. And when you sum them up, it comes to be 15%. It means the overall average expected return on the stock or the portfolio, whatever, is 15%. Now, where does this formula come from? This is PI, the probability of PS times return of ith company in S state. And when we keep multiplying them, and then we find the sigma, the Greek letter for summation, adding up in three situations. So here the three situation is 1 to 3. So we have three situations, probability we know in each state, and then the return the companies earn in each state. So when we multiply them, we add them up, and that comes to be the expected return. Look, if you look at the formula, it looks very scary, but when you see them, when you apply them, it looks comparatively easy, I would say. Okay, so this is the expected return, 15%. Now here, if we assume that the risk-free rate of return is 5%, then the projected or the expected risk premium is 10%. So being a corporate finance manager, if you're looking at the cost of equity, you must be familiar with the macroeconomics. And based on that, you will find out that what are the different possible combinations of the economic outcomes. Well, you can trust some analyst, you can read economist.com or something like that, or you can read Wall Street, whatever. But if you want to do some homework by yourself, then it's not a bad idea to get familiar with some of the macroeconomic indicators and what are the likely changes during the year, okay? And then you assign the probability, and then you find out that, okay, these could be the different situations, and then you are finding out. And if you know that if the risk-free rate, which is, let's say, 10-year bond, treasury bond, not the corporate bond, but the treasury bond, the bond issued by the state, because the state is riskless, even though the state can be very risky as well. Okay, if Greece was not a country, who knows, it would have not survived. If Enron was a country, not a company, it might have survived. So if the risk-free rate is 5%, then based on that, you can find out that the expected return the expected risk premium is 10%. It means that whereas the state is able to convince its investor to take 5% and invest, the corporate sector, the private sector has to convince them by giving them 10% extra premium. So this premium is a compensation for the risk which investors would take up in your company. So you need to see, when you're a corporate finance manager, you have to see the investor psyche also. You need to see that what is the mood of investors. If last year the risk premium was 7% and this year it's 10%, hey, is it something you need to introspect, or is it because of the unfavorable macroeconomic surroundings? Okay. Diversification, I don't think I'll be doing too much, because I think I said about diversification that diversification, the old adage we all know that don't put all eggs in one basket, even though I don't fully agree with this statement. Sometimes it's nice to put all eggs in one basket. If you're only carrying one basket with you and you're traveling somewhere. Yeah, so the idea of diversification is more valid if you want to protect yourself against the unsystematic risk. But if the nature of risk is more tilted towards the market risk, then diversification becomes obsolete, becomes redundant. And in that case, hedging, effective hedging, could be a good technique to protect yourself. Yeah, I think this also we discussed. When I asked, then this gentleman answered me. Yeah. When I see this picture, a few things come to my head. The first thing is that because we are talking about the risk here, and here when I see on the vertical axis, I didn't spell it very well, but it's like a standard deviation. So it means that, again, it's difficult to say. Risk is a very qualitative phenomena. And if you want to enumerate this qualitative phenomenon and you want to make it quantitative, then we need some statistics. And in this case, the risk is measured by standard deviation. And I believe it that I have no disagreement with it. There could be various other measures of risk as well, but the most trusted and the most widely used, even in the empirical research, I use these risk measures quite a lot in my own work, is the standard deviation of the stock return, if I see from the stock market perspective. But of course, you can find the standard deviation of cash flows, the revenue, the operating profit, whatever. But because you need more observations, and because you can't have the daily observation of the profit of the company, but for the stock, you can even have the minute-to-minute observations as well. So that is why the standard deviation of the stock return is a very widely used measure of the total risk. And then on the horizontal axis, it shows N, which means that the number of stocks. Ante raised a very good point that if we have a few stocks or one stock, then the curve would be almost coming from infinity. So it will be parallel to y-axis, which is true. But as the number of stocks increase, you find that the curve is becoming flat. The total risk is going down. Okay. However, the total risk is, just a sec. Sorry about my, so if risk is here, if the N are the stocks, so if N becomes infinity, it doesn't go like this. And if I extend Ante's question, so it should come like this, basically. But my point is that why the risk is never zero? Because if you are investing in almost all the stock in the country, in the industry, in the sector, in the world, why is so that your total risk is not becoming zero? Because when we see this picture, when we see the slide, even when the N is infinity, look here, the picture over. So N is infinity. Even then, the risk is positive. It is because the market risk is here to stay. You can buy all the stocks, but you can only reduce the unique risk, the firm risk, the micro risk, unsystematic risk. But you cannot reduce the systematic risk. You cannot reduce the market risk. You cannot reduce the macro risk. This is why when you are having a small portfolio and then you have a very big portfolio, your total risk as measured by standard deviation is definitely going down. But look at the decomposition, look at the breakup of the risk. Systematic risk, unsystematic risk. Your unsystematic risk is going down, but your systematic risk is not going anywhere, because diversification is not a solution to the market risk. So this is why this picture tells me many things, that if you are a corporate finance manager of a company and you are calculating return, and at the same time you also want to see the risk, don't feel very happy that you have brought risk and return into the discussion. Your next job is to break up the risk into systematic and unsystematic components, and then find out that which of the two is a major threat? It could be possible that over the time, your project's risk is going down, but the unique risk, the market risk is going up, is more than before. So in that case, remember this picture is static. It is at a point of time, but if you do the analysis over the period of time, you may find that, hey, in the last 5 years comparison, the standard deviation of stock return, the annualized standard deviation of the firm's stock return, which is a measure of total risk, has gone down, okay? But at the same time, the component in this share, the element of unsystematic risk is going up. It means that even though the total risk is going down because the market is very favorable, the risk coming from within the company is going up. So we need to do something. We need to look at our operations. We need to look at our internal control system. What is going on? Are we doing some wastage? Is anything which is unreported? Okay. So these are different foods for thought, which you may carry on with. All right. So I think today I would stop you here. I will not go beyond this. Maybe tomorrow morning, I would be sharing some 3 or 4 research articles about capital structure and cost of financing. And please go through them, and we can have discussion next week. Remember that I told you in our first meeting that I will not ask you straightforward and very generic type of questions. Hey, write a note on cost of capital. No, I will not do that. Of course, you have to write down the dynamics of cost of capital, meaning different terms. Of course, you need to write. But I would, in certain cases, I might ask you to answer a certain question in the context of a research article. Okay, so please take these articles very seriously. Maybe it's a good time to discuss with you what to read or what not to read in the research article. I don't pay much attention at this stage on the methodology part. So don't get awestruck by the sophisticated econometric equations. Don't worry about that. So if I were you, and I have to read some research article, my teacher is very strict, like I am, then I would first go through the introduction part. Well, it can be in any order, but abstract, introduction, review of literature of the article, and then finally, discussion part is something which I would really go through. I will try my best. I may give a little bit less importance to the finding section of the article, and I may give even lesser importance to the methodology part, unless I have interest and something is really interesting there. But if I have to prioritize different sections of a research articles, reading first time, okay, without having too much of background of econometric and all these analysis technique, I would go through the abstract, I would go through the introduction, I would definitely go through the review of literature of the article, and then I would go straight away to the discussion and the conclusion part of the article. And I would give comparatively, if my interest develops, then I would go through the findings, and finally, if I'm still brave enough, then I would go through the methodology part of the article. Okay, so these are the things which I expect you to go through. But tomorrow morning, I would be sharing. And remember that in the Moodle, there is a separate folder called research articles. So you will find a series of articles there. For some articles, I would give you the PDF version, and for some, I would be giving you the link which you can access directly by yourself. Okay, so please, if you have any questions or anything to discuss with me before we close our meeting, please let me know.